Right, we are live. BYOB, ask me anything.
We got one question came in here. I'll read it out. It's not in there. Okay, so this is from a client. They said, is there a loan protection foreclosure on it regarding their policy? So that's the first question. So to the team, that was the question. Is there a loan protection foreclosure on the policy?
So
what's loan protection foreclosure?
Loan protection foreclosure. I don't know where they got that. It just came in literally about 5 minutes ago.
It almost sounds like they're looking to understand, is there a protection against loans lapsing the policy, perhaps?
Perhaps. I'm not quite sure. I've never heard of foreclosure in conjunction with a life insurance policy, first off. Okay, here's the second part of the question. Maybe this will clear it up. We went to see a financial planner, and he said we shouldn't take out loans in the early years. Anybody want to take that one right there?
Does the financial planner practice infinite banking?
I think that's my first thing right there. Is like, does that person do it or not?
Well, a traditional whole life policy, they can't take loans in the early years. Correct. And so I'm sure they're probably discussing that.
Yeah. So this kind of illustrates sometimes the conflict that you're going to get when you go to a traditional financial planner who doesn't understand infinite banking or these kinds of strategies, and they try to apply their knowledge to it. It's going to create confusion in the client's mind, and that's a very bad thing. Versus yesterday, I was on a call with a financial planner who was purposely on the call to learn how infinite banking works so that he could actually understand how to use it in his own life. And then when it comes across his desk with clients, he can talk about it intelligently. Two very different approaches.
I wonder too, Brian, if that person's perspective was it's a direct recognition policy, and so he's saying don't take the money out early to go do something with it because it's going to impact dividends. But who knows? We're speculating.
Well, in fact, they just 1035 from Penn over to a different company.
Okay.
Yeah, not because of the direct or indirect, but for other reasons, because of what the other person set up on the policies. But yeah, so that might be the issue. They're thinking, he might be thinking it's like a Penn policy, which, by the way, direct versus non-direct. You guys don't know what that is. Penn Mutual is a direct recognition company. If you take a loan from your policy, that changes the amount of dividends you earn in the policy. So it's interrupted compound interest versus Lafayette, One America, other companies. Non-direct, meaning if you borrow, it does not change the amount of cash value that you earn dividends on. That's uninterrupted compound interest. So, yeah, I got to clarify with the client, though, of course, these things. But it was an interesting question when they said foreclosure. So
yeah, I wonder if it would also make sense if that financial planner was maybe thinking in terms of an IUL and taking loans from it in the early years.
Yeah, even then, usually if you have a lot of the ones I've seen have high surrenders. So you can't even access the cash value, even though it's there. You can't access it, which is ridiculous. But Drew mentioned it. Maybe this is for an IUL. The current policies are not IUL. But yeah, and VIA says loan insurance in case you lose your job. Maybe there's actually another. No, that's not even for loans. That's for the premiums, waiver of premium riders. Which actually had to ask. Linus and Craig and Jason. Do you guys get questions on waiver of premium riders very often?
Typically, never actually.
Yeah, I never have. Yeah. So yeah, cool. So anyways, that was the question I just got in. Very interesting.
Yeah, the waiver of premium rider is a great strategy if somebody is concerned about in the future not being able to pay premiums due to a disability. So it is an option, but it's not free.
We do have one question in the chat right now. So Via Logos is saying, what's the average amount of time it takes to start IBC when you first decide to start as a newbie?
Talking about the amount of time to get approved. I mean, it can be really fast depending on how excited or how confident you are to go through the process. I went through the process in 14 days, one time, 18 days with a full paramedical. Another time, I've had people go through in less than 24 hours after they do the application at this point. So it really depends on you, what you're trying to accomplish. But the first thing you want to do is have that big vision of why you want to do this, read R. Nelson Nash's book, watch the 90-minute video, and book a call with us. Like that's how you want to go about this. And then you can decide what's going to be the best route for you. Steven liked that answer.
Read the book, baby. Read the book. Very important.
All right, here's a question here. Hi, everyone. Does the split of the policy change if someone wants to contribute the full premium for 20 years over a typical 10 years?
Yes, that will impact the ability to pay the premium longer. So if you have more of that split going to the base, there's more of an opportunity to fund it for longer. So those those are kind of the teeter-totter trade-offs. The higher the split for the cash value, typically the less amount of time you can fund it fully. But
to answer the question, so we illustrate them for 10 years usually, just because that's the point at which they become very efficient when you drop the PUAs off. In some products, you can't go for like 20 years. You just can't put them in there just because of the MEC. Different companies, different products, it's going to be a different duration. But when I'm talking to a client, I always inform them of, I'm showing it for 10 years, but you can put it in for X number of years if you want to. Like we're just showing the 10 years. And I'll typically sometimes do multiple illustrations showing them here's the maximum and here's the 10-year illustration so they can see both options. But some of the policies have your 10 years, you're done. It's called the 10-pay policy. You have a 20-pay policy, 30-pay policy. But Jay, I would just recommend asking those kind of questions when you're talking to the agent. So when they're building the illustration, so you can see all the options.
And a lot of that split, Jay, is going to be driven from what you're trying to do. So, if you're trying to get a lot of money in, a lot of money out, we'll typically do a higher split at the cost of maybe some ability to fund it longer. So, but that's what all of us do is we have those conversations and then we help you build out the right policy for you.
Yep. All right. Jose said, can you still do this infinite banking if you have a bankruptcy?
Yes. Depends on when the bankruptcy cleared. It's got to be at least 1 to 2 years, typically, depending on the carrier. So
now one thing I'll mention to add on to this one that I just came up with a client that had some issues. They had a bankruptcy, but it was 4 years ago. But what they also had in addition to that was was what I call their credit profile. Their credit profile was not good because you all have a credit score. We also have a credit profile. Their profile showed that they were very inconsistent with making payments to their debts. They had a lot of late payments. They had a lot of missed payments. They had a lot to go into collections and then came out of collections. And so because of that history of how they dealt with their money, the life insurance company would not do a policy with them because they felt there was too much risk. So even though their bankruptcy had gone was 3 years ago, their last 3 years did not look good though either, which is probably why they were in bankruptcy. So just keep in mind if you have a bankruptcy that is beyond the 1 or 2 years mark, but you want to make sure that you're being very responsible with your cash flow and your credit profile. So you can get approved. So this is kind of something I came across. Wanted to share.
Yeah, there are some options to get somebody a policy even with a bankruptcy that was even just recently discharged. I had somebody get approved with a bankruptcy that had been discharged like a month before the application date. Wow. But some of that depends on the type of the type of bankruptcy, what chapter, and kind of the dynamics of that. And like Brian was saying, the dynamics of your credit report. Those are individual data points that you can communicate with your agent, and they can go directly to preliminary underwriting and kind of get their idea on how they might handle it.
Reminds me of an old friend I used to have growing up. He was a firefighter. He had twin boys. They were my good friends. He named them Jose and Jose B. Anyways, just reminded me of that.
Stephen laying down some dad jokes. I love it. Absolutely love it. Well, Lucy, no, I don't have any YouTube videos of me playing guitar, but if I did, I'd probably be banned from YouTube. It's that bad. No, I don't. I just like to play, kind of doodling around, but never really been out public with it. I have played a couple times in public, but nothing great.
You're at the backup for Metallica?
Yeah, I used to play with this band. They're a bunch of electricians, AC/DC, and
he went there.
He went there.
I like it.
All right.
Joe. Are we without Steven for the rest of the time? Is he gone?
I don't know. He just turned his camera off.
Okay. He likes to pop in and out like that. Oh, he came back. Look at
Oh my gosh.
That's amazing. I'll vote for you. Who are you?
Yeah. Okay, you can vote for Kamala or Trump or the guy with the bag over his head. I'm going bag over the head.
We're going bag over the head guy. Yes, please. Or woman. I don't really care.
It's a crapshoot right there. I'm going to go that one. There's the eagle.
Nice talons. I like it. Yeah.
That's nice.
Bird of prey.
Okay. All right. Can IBC be used to fund a trust that it holds a different LLC?
Craig, you have a trust.
Yeah, I mean, it's the challenge with this would be there's so many different kinds of trusts. And I was having a conversation with a client today, and there's revocable trust, there's charitable trust, there's irrevocable trust, there's all these different types of trusts. And
trusts, yeah.
So what typically you can do is the way I kind of look at it is if you have a revocable trust, the main purpose of that is to stay out of probate and just kind of have some end of life instructions where in that perspective, I would see the IBC policy maybe being owned by you, and then the beneficiary is the trust, the revocable trust. Irrevocable trust, the trust could be the owner, it could be the beneficiary, it could fund other investments, but that's really where you would need to talk to your estate planner, your attorneys, your CPAs, figure out what's right for you. But there's a lot of different opportunities to structure that. But I think at the end of the day, the way I describe it, there's three main entities in a life insurance policy. There's the owner, that can be an entity or that can be a person. There's the insured, that has to be a person of insurable interest. And then there's the beneficiary, and that can be an entity or a person.
There you go.
There he is.
There's Joe.
Jojo.
Hello.
Are you busy reading?
Yes. No, I had a phone call.
He was busy reprogramming his computer. So Anderson says, in the early process of getting a cash out refi loan, I want to get second policy started with as much as money as I can put in from the refi to pay off consumer debt. How we figure out how much we can put into at our income. So that's just a calculation based upon gross income, net worth, liquidity, a couple different factors, and age. But the maximum is anywhere from 15 to 30% of gross income on average. But it can change based upon liquidity and other things. So get a second policy out as much money as I possibly can put up refi. So it depends on, also you got to consider the dump-in versus the premium deposit too. So you have your premium, which is based upon what I just said, but the dump-in is a ratio of that. So a way to get as much in would be a combination of a premium and a dump-in. And obviously one of us on our teams can go through that with you and kind of give you the ranges and the numbers of what that would look like. And then look at a couple different companies because they have different numbers for different companies. Anybody else want to chime in on that one?
Yes, I was going to say,
Yeah,
you're reading
I just
and
did one.
answering the questions. Go, Gabe. Reading and
I actually just did an exact same one. Craig made me the policy illustration and getting ready to go enforce.
Any other details? So one of the things you said, how much can we put in at our income? Brian touched on it, but it's just 20 to 25% of what you earn can go into the premium deposit portion of things. The overfunding to get more in is going to be based on your age and your income and how insurable you are, right? Like how much insurance can you carry? So those are the two kind of variables. But no, like if you make $40,000 a year, the most you'll be able to put in is up to $10,000 a year as a premium deposit, just to give you a number.
Yeah.
So you guys know I have to say it. Anderson, why do we want to do a cash out refi loan and give the bank a paycheck instead of a HELOC? Because if you can get the refi, you could probably get a HELOC and then utilize that money once you put it back in. You're just taking the money out of your 2x4s just to put it back into your 2x4s.
Yeah. And the bank likes you to do a refi loan versus a HELOC.
It's just a paycheck for them to restart the clock.
Yeah.
So a lot of times what we teach and talk about is the ability to control the money that you have, and that equity in your house is something you want to be able to control. And by using that first lien HELOC strategy, money's in and out all the time, and you're not asking the bank to pull it out. It's just in and out, in and out. So all the income goes in there, expenses come out. But
he might not just know how a HELOC really works. So
yeah,
that's why I asked.
No, it's a really good point, because every time you refinance, we're resetting that schedule, and they love that because that volume of interest goes back up to the 70 to 80%. And when we talk about volume of interest, what we're measuring is how much of that payment you're making. So let's just say you're making $1,000 payment to your mortgage, and if $700 is going to interest, we'd call that 70% volume of interest. 70% of that payment is going to interest. 300 is going to buy the loan down.
And if he wants to talk about the interest rates, there's a huge difference between amortization with your refi and simple interest with a HELOC. It's night and day.
Yeah. So lots of good stuff there, Anderson. I see there's a comment asking how you can get in touch with me, but if you want to just shoot me a quick email, craig@chrisnoggle.com, we can chat.
All right. So the next question we got here. All right. Is there a success story of someone who has very little money to start IBC that you have seen? In other words, someone with a small amount of cash flow.
Yes. My partner, Brianna.
Elaborate.
Dozens and dozens of those. Yeah. I mean, I was one of those people years ago, by the way.
She started 3 years ago with, I believe, $250 a month. It might even be less than that. And now she's spinning through 13,000 through her cash value.
Yep.
Paid off all of her debt. Now she's working on the husband's. So yes, absolutely.
Start with where you're at.
Yeah, and I can share a story too of someone I worked with where, so Night of Israel, what their situation was, they have some debt. They're living pretty much, income and expenses are equal, and they've got a lot of debt. So what we did is we looked at their debt, and they were paying a few $100s more on top of the minimums than they needed to. So what we did is we took that extra and we ran that through a policy, and then we took the money out of the policy and threw that at the debt. And once they got all that third-party debt paid off, they simply started making that same payment back to their policy. So, and it's so cool because just within the last few weeks, that person had reached out, hey, got a couple credit cards paid off already. It's just really cool to see the process working for them. But
yep.
We're talking about $300 to $400 somewhere in that ballpark is what we started with on that one a month.
Sense.
It's a good process to see somebody go through with it and to actually make it happen. It's awesome.
So Anderson had a follow-up. Understands the bank risk. I watch you guys all the time, but you don't like using HELOC to start policy, correct?
I think we all kind of sit in different areas on this. Like, I think it depends. Like for me, I'm super conservative, so I want it to be your surplus money. Like, I want it to be the extra money, the savings that you have. Now I'm about to start using, my policy to put into my HELOC, into a first position HELOC, right? But I understand like all the implications and things. Like, I know that I have surplus money. It's just, I think it depends on where you're at financially. I don't want you leveraging your home, putting it into a policy if you're not really disciplined to begin with. Like, I'd be nervous.
So my question is, you're getting a refi loan. You're going to have money in your hand. What do you plan on doing with that money? Do you plan on putting on a roof? Do you plan on putting on a deck or a pool? Or do you plan on taking that money and putting it into an investment to make more money?
Vegas, baby. Oh, I was muted. Sorry.
If you plan on taking that money and putting it into an investment to make more money, then obviously you might as well run it through the policy first. So now you're making money in the policy and in the investment. So when it comes back in, it pays the opportunity cost of the HELOC. It depends on what we're doing with the money and how we're doing it. When I first started with Chris, I just took it from my HELOC and gave it to him as the investor. And then that money just came back to me. And then after I got the policy, I took it from the HELOC, ran it through the policy, and then handed it to him. So now I made money twice.
Yeah. And one of the questions I get a lot is someone gets a new HELOC, and Joe, you've heard this many times as well, and I got a new HELOC. I want to take $100,000 out to jumpstart an infinite banking policy. You've got to understand the implications of that. You got to understand that, okay, now you've got a HELOC loan balance, but you've also got an infinite banking cash value policy now. Now, what do you do? How's the cash going to be flowing through your life at that point in time is what you have to understand. Don't just go do that for the sake of doing it.
Right.
Because then you might get into trouble because now you've got this HELOC. So understanding velocity banking through the HELOC, understanding what to leverage the policy into as an asset that cash flows back into the HELOC, then back to the policy. You have to understand that circle right there.
It's just like you said, it's a system. So if we have A, the policy, B, the HELOC, C, the investment, every spoke that goes into that wheel does what? Makes it stronger and makes it go faster. So however many, the more spokes in the wheel makes the process and the system smooth.
And with a cash out refi, you don't have one of those spokes, which is the HELOC. That's the challenge.
Yeah. No
You've got a
spoke.
loan, a debt, but you don't have the efficiency of having a HELOC.
Yes, and what you guys, and thank you, Brian, for elaborating on, but something got you to where you're at now, where you have debt, you don't have, passive income, and you're looking for this to fund the policy. Like, there's habits that got you there. I don't know what the situation is, but it's really, like we said, like Joe understands this deeply because he's doing it for what, a decade?
Since 2010. Since 2010.
Okay. So that's it. Like, every single one of these is a piece that we have to learn. You're going to make mistakes. We're here to guide you on that. And you want to make sure you really know what you're doing before you do this.
Yeah. So he just said, paying off credit cards and pay myself back. I'm not sure what you're paying yourself back for, but you just got to be careful. If you're going to use debt to pay debt, there can be arbitrage. It's helping you there. But if you have a HELOC, it's actually a wealth building tool at the same time. That's the biggest difference. A refi is pure debt to pay off pure debt. It can be good for you because maybe the interest rates are better, but a HELOC is also it can be an asset at the same time as also using to pay off your debts. So that's why us and like Joe obviously talk about these things.
Yeah, and if you're trading if you go out and get a first lien HELOC and let's say you're refinancing into a 7.5% interest rate, and then you're using some of that money to go pay off a 30% credit card, well, that's a pretty decent trade. I mean, you're getting rid of a 30% interest charge for 7.5%. But there's a lot of different ways the money can flow. But one of the things I look at with the first lien HELOC too is even if you don't have a plan for it, get it if you can, because you've probably heard the old saying, the banker will give you an umbrella when it's sunny out. And when it's raining, you're not getting the umbrella. So then the question is, do you think we have some rain coming, or do you think it's going to be sunny for the next several months? So sometimes it's good just to get positioned to have that line of credit if you need it.
Partly cloudy with a chance of rain.
I think there's going to be some hail coming down.
All right, guys.
Another 7 foot of snow.
Yeah, we'll see.
So, all right, guys. Or if we don't have any questions, we're going to have to listen to some Craig dad jokes. So, get those questions in.
Well, I have a bunch of them here. Mike Stammet, who usually is on with us, throughout the day we share dad jokes back and forth. So I usually have a plethora of them ready.
Right.
Shauna loves these.
Yeah, let me hear what you and Mike are texting each other.
Well, we actually had some serious stuff here, so I got to scroll back up to the. All right, here you go. So my friend claims he glued himself to his autobiography. I don't believe him, but that's his story, and he's sticking to it.
Oh boy.
Yeah. I was telling Mike just the other day, I got a telemarketer call. This guy's selling, funeral expenses, and he, wanted to know if I want to buy a coffin, and I said, I don't think so. That's the last thing I need. All right. Anyway.
Please send some questions.
All right. There we go. Can you use IBC in place of health insurance or auto insurance?
I'll say a couple things on this. I don't personally do it, but there have been people that teach. Let's just say you've got auto insurance and you've got big deductible or you've got comprehensive. If you take the comprehensive off, and let's say it's $500 a month, just making numbers up. If you take that $500 and run it through a policy and just run liability on your car, then you're actually getting more benefit from that comprehensive payment. Now, the risk is, are you going to get enough money into your policy and not have an accident that you would have to potentially pay for? But essentially, there are some people that use those policies to cover, those types of comprehensive type insurance issues. But I don't personally do it because I ran the math and I look at it and go, I don't know, the risk of totaling out my car isn't worth the risk in the short term.
Yeah, R. Nelson Nash actually wrote about it in the book, Warehouse of Wealth. It's like, what is it, chapter 8, comprehensive and collision insurance on autos. Pretty cool thing to read about, but it doesn't really make sense for most of us unless you're in it for quite a few years and have a lot more insurability and you don't have a use for all the cash value. I think is kind of how I read into it.
Yeah, so it's one of those things where if you had built up cash value in a policy and you had enough to cover an issue where, say you have an accident, then maybe it would make sense for you. But I would say as a starting place, probably not the place I would recommend starting. But it could certainly be a strategy for down the road.
I think Steven.
I think the eagle should just stick around for the whole time. I like Joe going red. Can you make some eagle noises and do the talons again?
Lord, oh man!
Just read the book, guys. Just read the book.
Steven, how many times have you read the book?
Yeah, a few.
Good.
Oh, what's Mike's question here? What's the gentleman's name of the IPG fixed income fund, and how do I get in touch with him? Chris had him on one of his podcasts.
It's
Arthur
actually
Miller.
Lena.
Arthur Marshall.
Right?
Yeah.
Arthur Marshall.
Mike, you can email me and I can connect you in email with Lena, like Craig just mentioned, and Arthur, so I can connect you if you want to email me.
Thoughts on Forester as an IBC carrier?
Just say no.
Somebody, and I don't know who it was, they shared with me some Forester policies, and I don't remember the structure of Forrester, if they're mutual or stock. But anyway, the policy looked interesting. I think they're a mutual company, aren't they?
They are.
Yeah, they are.
I've seen quite a few there of clients with Forrester policies.
But yeah, so it didn't look like a bad, it actually looked like a decent structured policy. We don't specifically work with them, but would it work? I imagine it would. This is not who we work with.
I'll say a few years ago, we were exploring some new companies to use, kind of around when Mass Mutual kind of did their thing, just to make sure we were still using the best companies that are out there, mutually owned companies. And, we ran some illustration stuff with Forresters, with Emeritus, and at the end of the day, One America Lafayette, SML just really crushes. Better designs, better loan rates, better history of dividends. And so that's all the stuff we kind of look at. So we decided not to move forward with any contracts with Forrester or Emeritus because of that.
I was going to say, I got that question before too. And, and if you're looking just at the policy structure as a reason, that's kind of putting your blinders on a little bit. And so I've always said that when we have companies that we have relationships with, which give us an edge on things outside of just the policy itself, customer support, if we need to make a change, something goes haywire, all those different things are a benefit to our clients that you might not see just on the illustration side itself. So kind of keep that in mind as well. Like, as Stephen said, the history of the company, their dividends over time, all of the things play into who we want to work with. And since we are, the largest producer of IBCs for these companies, they're pretty serious about who we work with. So,
yeah, and I was just going to add that there's a lot of companies out there that may or may not work, but one of the things we really enjoy about the Lafayette and One Americas of the world is they also are on board with infinite banking as a process. I believe in the last Nelson Nash think tank, I think One America actually sponsored it. So, these are companies that are fully behind the process and like the whole concept. So that's another feather in their cap.
Yep.
What do you guys? I got a question for everyone. What do you guys think about my new fanny pack?
I think it's empty.
It's very, yeah. Isn't this a happy hour? Where's the drinks, man?
I got to fill it with some cans and bottles.
Where's your hat that has the?
Oh yeah.
Oh, yeah, on the East Coast, it's 4:30, or well, actually, no, it's 5 something now.
Oh,
It's 5:18 now.
Yeah.
Moving along.
When it comes to that kind of stuff, I go by East Coast time.
Mm-hmm.
So Night Visual again said, I was considering it because I've been paying for health insurance that I never use, and was thinking if I got rid of it, could I put that money into whole life? So that's referring to using IBC to pay for insurance again. Yeah.
Again, I just would weigh out the short term. It's going to, if you're starting out day one, are you able to take on that impact of a major health issue or wrecking your car? So you may need to build up the capital before you can get to that point. Would be my only concern.
Yeah.
Just starting fresh.
I mean, insurance can be catastrophically, health insurance. Ooh, my father-in-law, this is part of why we're moving to Idaho, is he's got very terminal cancer right now. And he's lucky he's got union insurance, but the cost of what it is for one treatment for radiation and chemo, it is absolutely staggering how expensive it is. I mean, it is mind-blowing. So just kind of keep that in mind that might not be used now, but it could be down the road. You just never know.
Yeah, so the way I was reading that question, it sounded a little bit more like he was considering, sorry, I don't even know, Night of Israel was considering to just drop health insurance and take the risk. And I mean, I can't recommend that in any way, really, because you never know when that event is going to happen. But I mean, I can see the value of all that money that's going out into the health insurance premium redirected into a whole life policy. But you no longer have that health insurance to cover you. So I can't recommend it. And that's coming from a guy that doesn't have health insurance on himself. So, yeah.
We have clients that dislikes paying taxes. So every month they take money, they run it through the policy. And when the tax bill comes in, they utilize that money to pay their taxes. You could do it this way. You could run the money through the policy that pays your car insurance or your health insurance and utilize it in the same way.
I think
Right.
insurance, like the way Nelson describes insurance too, if it's not protected, then you don't really own it. Like somebody can take it away from you, right? So like with most insurance, like your car insurance, the question's really, what's the lowest amount you can pay for the coverage that you need in case something does happen, right? With a reputable company. Same with health insurance, same with any home insurance, flood insurance, all of those things. Where what we're teaching you is how can you pay yourself the maximum with the lowest death benefit, right? So like if you're at this stage, like one of the conversations I have almost daily now, it seems more often than I'd want to have this conversation, unfortunately, but I had it this morning, was like, well, how do I get my income up? I was like, well, A, you can work more hours. B, you can get a promotion and get a promotion. C, you can get a side hustle. Or D, you could do something else that they would pay you more money, that you have more value in, right? There's not really magic to that piece, but that piece is if you're going to do infinite banking, you have to be able to make money. If you're not making money, you're not ready to be a banker. Just it's pretty much that simple. Like it takes the discipline of doing those things, and if you're not doing those things, I wish Gabe was still here with discipline, jiu-jitsu, tying all that together, but that is the first discipline. It's being able to make money and have cash flow.
Yeah.
Make and save money. If you're not doing those two things, go give yourself a 90-day challenge of making money and paying yourself first. Like do it like the commandments. 1, God, heart, mind, and soul. 2, love thy neighbor like thyself. That's 1 God, 2 you, 3 neighbor. If all your money is going out to bills, you're going 1, 3, 2. You've got it backwards. You got to make money. You got to take care of yourself. You got to put your oxygen mask on first, and then you can go from there.
Unless you're the government, just print money out of thin air.
Completely different. It's set up to be that way since 1913, since the Fed's been put in place, that it's one giant counterfeiting system. And that's just the way it is. So we play that game, but we have to know the game that we can control and protect our family, which is why we're here teaching. So
Yeah, it's kind of funny. If you look at it that way, which I like what you said, Jason, it's like, if you don't like what the government's doing right now, what we do with infinite banking is the exact opposite on purpose.
Yeah. And the deeper you go down this rabbit hole, the deeper you're watching the videos, you're reading the books, you're doing the things, the more you're going to feel like you need to put on a little silver hat and you're a conspiracy theorist all of a sudden when you really see what's happening. And then when you see it, like Chris can't unsee it anymore, which is why he's always cussing and angry, because how could he not be? He's like, don't you guys get this? He wants to shake you. He wants to slap you like Joe likes to do on his phone calls. It's like once you guys see this, the deeper you dig into it, the more you'll see that what we're saying is really true. And there's even going to be more optimizations that we're going to keep bringing you because we're going to keep learning and getting better.
I saw somebody the other day said that I'm in so much debt I could start a government. So
I had no joke last year. I had a call with somebody, and again, some of the calls we have, I have to laugh, otherwise I would definitely cry. But they literally, it was a notebook like this, half another page. It was a his and her credit card for every single financial institution you could think of. It was like, oh, we have my Wells Fargo this. She has her Wells Fargo this. We have Bank of America, Citi. And it just went on, and Navy Federal. It went on and on. At some point, I was just like, I don't have any more paper to write on. Like, when were you going to stop taking out credit card debt to pay for everything?
I did that with PLOCs. Very different, though, of course. All right. Sandra had a question here. I will be setting up an appointment for next week. I'm 58. Should I get a policy started now or get my 20K credit card debt paid first? 16K is 0% until next year.
Get on that call. They'll help you figure it out.
There you go.
Yeah, and there's a lot of paths this can take, and it depends on if you're thinking short term or if you're thinking long term.
0% is short term.
Because in the short term, just paying that debt off is going to get that debt out of your life faster. But if you want to have a long-term strategy where you start to keep more of that money, compound that money for the rest of your life, then it makes more sense to put it in the policy or go that direction. But, just what Linda said, just get on a call with one of our money mentors and we can go through this and kind of figure out what's best for you.
Any dollar that doesn't run through the policy leaves your family forever.
There you go.
And we call that opportunity cost.
Yep.
Every dollar that that you have in your hand, you have a choice. As soon as you spend it on something that's gone forever, you can never earn with it. You can never use it again. And so really that's the basis of everything we teach is take that dollar, put it in the policy first, and it compounds and grows for the rest of your life. And then you do things with it throughout your life.
And who's in control of that, Craig?
Well,
I love Sonia's follow.
the owner of the policy.
So Sonia gave a follow-up. She's gonna have 20K by December. So that's awesome. I mean, just like you finance everything you buy. You either pay interest or you earn interest, or you give up the opportunity cost of earning that interest when you pay cash. So that's what Craig just said. This is a different way of saying it. So I love that she'll be talking to us. That's good. And one thing, Craig, you said that made me the happiest is the thinking long term. That's the first principle about everything we teach. So a lot of times when we're geeking out about policy illustrations, it drives me crazy. We're trying to pull money out as fast as possible, getting 90% doing that, because that's all short-term thinking if that person isn't really committed to banking. So it's like, how do you shift that paradigm to get them to think about the next 40 years versus the next year, 2 years, 3 years?
Yeah. And to add on to that, this is a question that I have a client right now that is, they were super excited because they had some perceptions of infinite banking that were not quite correct, I guess I would say. But here's a question. So to any of you guys on this call or anybody who's listening, so if you have a possible, you can take a loan out from a bank. Let's say it's at 3% for $50,000 to go buy a car or whatever. Or you can get a policy loan at 6%. Which one would you do? You can go you have a policy, you have an infinite banking policy that has $50,000 of cash value. You can borrow that at 6%, or you can go to a bank and get a $50,000 loan, same structure potentially, for 3% or 3.5%. What would you do?
Depends on your ability to pay back the terms. Like, right, with the
They're the same.
Again, it depends. It depends, because in infinite banking, the big difference is you have different ability. Joe's shaking his head no, but I think it depends because you have 3 ways you can pay back the loan when you're borrowing from the policy against your money, right? When you're borrowing from the general fund of the life insurance company.
I say the policy because I'm in control, and if I can't make a payment that month, I don't make the payment. What do? I'm not going to take.
That's my point. You have more. If the person's able to make sure they're making the equal payment back, I mean,
so the reason why I asked the question
is cheaper.
So here's why I asked the question, because that person is saying, yeah, but the bank's cheaper. Why would I go do this? They kept saying the bank's cheaper. I said, okay, why would I? They're saying, why would I start a policy too at the same time? And my thing is if you're looking just at the percentage, you're blinded by just the numbers. When you pull back to the 30,000 foot level and look at the bigger picture, for us, and I told him, I said, for me, infinite banking is always going to make more sense. I will gladly pay 3% more to be in control of it, to have the future value growth, to have the dividends, the privacy, the protection, the death benefit, stacked benefits. And so he's just trying to compare one little tiny part of infinite banking to a bank loan. And I was saying, you can't, in my opinion, you can't do that.
And as you pay that back, you're going to do velocity. And is that 6 really going to end up being 6? Absolutely not.
There you go. And I got into that with him too, because he had a HELOC. And so I went through the math. I even pulled up our slides from the presentation and showed him, because he said, oh no, if you're paying 6 and earning 4, I'm going to lose money. I'm like, math is math, and you're wrong. And I showed him. He's like, all right. But anyways, it was an interesting phone call, and we're going to have quite a few more. All right, Camoab, hope I'm saying that correctly. If someone was taking out a second mortgage for $100K and had $60K credit card debt, would you suggest they put the $100K into a policy and then take a loan to pay off the debts to start the policy with $40K?
Goes right along with the question we had before.
Again, if I get this one, I'm telling you right now, I would not want to help this person move forward in this manner personally. Just because I think there's too much risk, I would feel uncomfortable with it. And that's just, my preference of being conservative as an agent. Like, I have a fiduciary responsibility to whoever I'm helping. And if I wasn't confident that their discipline was there to do this, I wouldn't want to do this.
Yeah. So you're taking out a mortgage. So it's the same situation as what we were talking about before, refinancing a property. Yep. Like, so first off, the question I'm going to ask is what is the best financial vehicle for what you're trying to accomplish? It doesn't have to be infinite banking or a mortgage. It can be something else. It could be a HELOC. So in this scenario, a HELOC might make sense. But as to what Jason said, infinite or velocity banking is not going to be a fit for everybody either. If you don't have good control of your cash flow and good financial habits, velocity banking is not a good idea because you can get over your skis and get in trouble. You've got to be responsible with your cash flow. It's why sometimes I tell people writing it out on paper might not make sense. You might need to go get some software, some spreadsheets, some help to do it because until it clicks in your head.
Well, with that point, Brian, I mean, we've got a tool called the Debt Blaster, and I recently did a scenario just like this for a client, and we took their second lien HELOC, we ran it through the debts, paid the second lien HELOC, and what we came up with for their specific situation, using the HELOC to go through the policy was not the best thing for them. Mm-hmm. So they were going to start a policy, but then take some of that HELOC money and throw it to debt just to get that out of there. And we kind of structured a payback for all of it. But and I would say this for Sonia, who also asked about debts. When you talk to a money mentor, just request getting a Debt Blaster report because it's going to show you how that debt pay down is going to work with your policy. But somewhere between what Jason's saying and Joe's saying is, the HELOC can work or it can't work. There's a lot of variables, and sometimes it's not even about the math. I like what you're saying, Jason. If you're not disciplined to be able to do something safe with that home equity, then that's a dangerous situation.
Yeah. Like what I hear a lot lately from here, and like I don't know why this is just really sticking with me today, and we're about at time, but one of the things we're hearing a lot is we're in a really tough financial situation, right? Like the weather, like it's tough right now. Like people, I'm hearing business owners struggling. I'm hearing people on the call struggling. Like I feel like I've talked to more people in bad situations in the last 3 months than I did all last year. I don't know if that's true, but that's what it feels like. And so when I know that people are desperate to find a solution, is infinite banking a solution? Yes. Is it the solution for everyone? No. Is taking control of your money the best thing you could do? Yes. Is having better financial habits the thing? Yes. Is paying yourself first the thing? Yes. But does it mean that this makes sense for someone? No. Because all the time we're trying to be helpful, saying, hey, we want to help you. Infinite banking has changed all of our lives. It will change your life if you apply it the way we teach you. If you apply it, if you become a banker, not just like, hey, this is the solution. The solution means you're making a lifelong commitment. You're getting married to this process and you're going to do it. I just feel like lately we're helping people that aren't ready for the help. And that's going to end up being bigger problems in the future, especially if we're leveraging someone's home, right?
And some of that leveraging of the home, Joe, you and I have talked about this a million times where, when you're using it for investing, that's awesome because you're creating that spoke you were just talking about. You're creating more momentum. But sometimes when we're using it for debt, it might be kind of a different approach on how we want to use it. But not to say it wouldn't work, but it does require a conversation. So I'd say just get a call booked and chat with one of the money mentors about it.
Absolutely. Yeah.
I like that response right there. I'm a CPA, and I wish I knew this 30 years ago. There you go. Absolutely.
If I had $1 for every time I heard that, I'd have a couple $1,000. So
this is a funny one. So I love what just Tessa said about the example I was giving of the client that was talking about the interest stuff. Like I tried to keep telling this because they were thinking that I'm my own bank, so any interest I pay comes to me, etc. That's a thing that people come across quite a bit. But I kept trying to say that you also have dividends, and he's have a mindset issue, by the way. It's a serious mindset issue. And so it's interesting watching him kind of go through the journey of trying to change his mindset, and he knows that's what it is, and he's trying to change it, but he's battling with himself internally. But look at this one. Someone's getting Lepucca getting the HELOC there as well. That's cool. Awesome. Yeah, I've actually been talking to quite a few people that are getting HELOCs right now. Someone just signed their docs today. Someone just got approved and will be funded. I think they said next month. So yeah. So Craig, a question on that one. You said that the Debt Blaster can take into consideration a HELOC.
Well, think of it this way. So when you take the HELOC out, that just becomes now another debt. Okay. So I put it in the Debt Blaster kind of towards the end because we're going to pay everything else off and then we have to pay the HELOC back.
Now, the question that came up with a client today, by the way, do we have any software that shows HELOC and IBC combined with an investment or asset?
Well, depending on what they mean by are they taking the HELOC, putting it into the policy and then investing from there?
Potentially, yes. Potentially. But they're looking at options right now. So they're trying to say, what would be the option? What would make sense from a
Yeah.
growth perspective.
Yeah. So the other software tool we have is that gain projector, which you can put cash in it, you can put policy money in it, project it out 15 years with some assumptions. But yeah, if you want to gather the details, you and I can chat about it.
Yeah, this client probably will because it's going to be a couple policy. But so, by the way, everybody, what you're seeing right now is us collaborate as a team in a group, which is one of the unique things that we do at the Money Multiplier and the BYOB is that we have multiple resources all in the same group, and that has been one of the biggest things that has helped a lot of our clients.
I just want to say one thing: if everything is going into the investment, and you have the cash flow and the entire HELOC in an investment, and then investment pays you back, that's how you pay off the HELOC. So you're technically out of debt when you have just as much cash value policy and your HELOC in an investment. So therefore, if you had a $400,000 house with a $300,000 HELOC, you have $300,000 in the investment, and say over another 4 or 5 years, you put another 100,000 in that investment. Now, when you sell the house, who pays for that house at closing? The purchaser. So now they pay off the HELOC. You have all that money still out there in the investment, making you cash flow per month that you can now use the extra 50 or 100 in your hand to put down on the next house and have your investment pay for it. Yep. So there's a kind of a catch in there that with that debt blaster, you wouldn't technically have to pay that HELOC back because you already had it in the investment.
Yeah, I like that.
And we could pull that out if that's the scenario. That's the cool thing about it. But yeah, that's exactly true. I mean, you've got that capital out there working. It's still yours.
Still yours.
You just take it from this hand and put it in this hand.
That's right. Yep. Yes.
Yes.
I'll be
Raise
moving.
your hand.
I'll be moving. Fun stuff. All right, last couple questions, and then we'll call it a day here. Where is the best place to learn about the IBC strategy for new life insurance agents? Read all the books.
Read all the books. Join the program at the Nelson Nash Institute. There's lots of good stuff there.
Yeah, becoming your own banker. Start there. That is where everything else is sprung off of. So there's a lot of great literature out there. Chris and Brent have Mapping Out the Millionaire Mystery, which is kind of a newer take on Nelson's book, but Nelson's book has so much depth to it and how privatized banking really works. There's a lot of good books out there. If you really, really are serious and this is your passion, then go through the Nelson Nash practitioner course and you'll keep learning and learning. There's so much there.
You guys missed step one though. Start
You
your own policy.
You have to be a practitioner yourself.
Yep.
Yeah.
Exactly. So your step one would be to get with us and start your own policy with us, so you can go through the process, see how it's done, see how we do it, and then go from there.
I'm going to say at step 2, go read the book first. Then we can help you.
CPI is in. Rates are going down a quarter. Hopefully deflation can be staved off, or else QE38 is coming, which is kind of funny because I was reading about that today. That's my concern, not trying to lose value. HELOC whole life. But are whole life loan rates going up? So kind of a few questions inside there. The best thing is no quantitative easing. That would be the best thing to happen. Because otherwise you're just kicking that can further down the road and it's going to be more impactful. Austrian economics. Anyone want to adjust the whole life loan rates?
They're always moving.
Yeah, we do see them going up, going down. So those will be adjusted as rates go up. Those typically follow. And what's the lagging thing that usually follows that activity is dividends go up too, because in higher interest rate environments, insurance companies typically make more. When they make more, who do they share it with? Us. So, but I would agree with this statement about my concern is trying not to lose value. I think we're in a period of time where, and Chris has talked about this, Stephen, it was on the 3-day, and preservation of capital is the big thing right now. Preserve and protect.
All right, another AMA in the books. Look at us going into OT. Stephen, anything to say as we wrap up?
Close this out.
What's the Eagle have to say?
Yeah, bring the Eagle back to wrap this up. Come on.
Oh, you guys just hold on 1 minute. Let me see if he's available. Hold on. Let me see if he's available real quick.
Oh, Joe's going to turn red. Someone went off the screen. They're going to come back. Joe, it's a magic trick. Here he comes. And that's it, folks. We got the Eagle present. Another edition of AMA after a good WTF earlier today and a wealth webinar. So go watch the replays. Go learn more. And remember, love yourself a little bit more, pay yourself first. And some people will see you next week. I think this is Brian and Shauna, but we'll be back soon. Have a good one all.